Good morning. Welcome to America First Wealth Management Investment Outlook for October 7th, 2024. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First Wealth Management. And joining me today, once again, is Michael Cheah, our Head of Fixed Income and Portfolio Manager. Next slide. So this is our standard disclaimer. We're not offering any investment advice. We're just giving our commentary on the markets. And our outlooks may change as market conditions and data change. Next slide, please. So what we like to do in our investment outlooks is Mike and I begin with our conclusions and then support it with information. And so people who are just interested in hearing what we think is going to happen, we'll get it up front. And those who want to follow for more interesting data that follows, please continue to listen. So my market outlook, as I said last week, we're expecting October to witness higher volatility with corporate earnings, and the financial sector earnings kick off on Friday pre-market. So that'll be certainly beginning of some fireworks, we believe. We made a good call on the energy sector last week, believing that it was undervalued and had opportunity to rise. And you'll see it was the strongest sector performance for last week. Also, the Iranian missile attacks on Israel and Israel's subsequent retaliation has increased attention to energy as well. We're seeing increased attention to emerging markets, Chinese stocks, and dividend stocks, and we expect this to continue. The Magnificent Seven stocks appear to be losing steam. We'll be showing some charts about that. Only 2 of the 7 are showing upward momentum right now. However, we still believe that near-term dips will be buying opportunities as the overall economy still appears strong, and the Fed will likely continue easing if inflation data is tame. And the key macro data points for the week will be Wednesday, 2 o'clock FOMC minutes, Thursday, 8:30 a.m. inflation rate, Friday will be the PPI and Michigan consumer sentiment. So those are things to watch this week and give you some idea on our outlook, which does remain constructive. Next slide, Mike. The weekly market stats largely were impacted by 10-year bond rates backing up. You can see at the bottom, the iShares Core U.S. Aggregate Bond ETF was down 1.22%, which does suggest that rates did back up, which they certainly did. Stock indices were choppy, slight positives by the Dow and the S&P. However, the more growthy indices, the more volatile ones, the NASDAQ 100, and Russell 2000 index were all down. Large growth and large value stocks were up slightly as measured by the Russell Growth and Value 1000 ETFs. Next slide, Mike. The S&P 500 index continues to appear in an upward trend. However, it looks like it's leveling off here, probably in anticipation of earnings reports and further economic data. The RSI, Relative Strength Index, on the bottom suggests that we're getting towards the overbought region. It can still move up a little bit, but it does suggest that we're going to be choppy going sideways, perhaps for the next few weeks. Next slide, Mike. In terms of the 10-year Treasury yield, I know Mike's going to talk more extensively about this, but week over week, the 10-year yield backed up 23 basis points, ending at 3.98%. In year to date, it's now up 10 basis points since the beginning of the year. So that's obviously a cause of concern. The 10-year, I know Mike has told me years ago that the most important number to watch is the 10-year yield number. So I certainly watch it religiously, as most people in the market do. Next slide, Mike. This is the yield curve, which shows a slight pickup. Oh, I'm sorry. This is, oh, yes, yes. It does show a slight pickup. The October is in the blue. The yield curve did pick up a bit. And it's starting to me, it looks like it's starting to appear more normal. Still inverted at the short end, but the shape is pretty interesting. The next slide, Mike, which shows the 10 minus 2-year spread, which had been accelerating, widening, had a complete reversal, which I think Mike will, I'm sure we'll talk about in terms of what these implications mean. But that in the equity analyst eyes that I look at, that tends to have negative implications on the financial sector. We do like to see a positive spread for financials to be borrowing short and lending long to increase earnings. Next slide, Mike. Turning it over to you, Mike.
All right, thanks, Dan. So my summary is a question asking, would the Fed have cut rates if they've seen the job and the ISM service data? Because these numbers are very, very strong and suggest that we're nowhere near a recession. Then the dock workers strike has been suspended with an agreement on a certain package. And while they're still going on, the pay rise might lead to other workers asking, what about us? We also want a pay rise. And then the surprise this week, number one is a TLT breaking down. In a week when we have this major problem in the Middle East, one would expect some flight to quality, but the bond long end sold off. And of course, a part of this could be because the oil price have gone up sharply, perhaps raising fear of inflation no longer declining as the Fed had hoped. So when we look at the data in detail, we see that the PMI for September, right, while the manufacturing, the blue color, is worsening, but the service sector is extremely strong, right? So to the extent that this economy is a lot more service-oriented than manufacturing, this net would suggest a stronger economy. And surprise, surprise, jobs came in at 254,000, and what had been an expectation of a decline over time has now been upset by this number here. And at this number, 254, it is a very strong number, right? And the jobless rate declined to 4.1%. Well, looking
Hey, Mike,
out,
can I interrupt
yes?
for a quick question?
Yeah,
I saw
sure.
some data saying that the September government jobs hires were record high hires in the government sector. And, what caused that? I mean, was the government creating all these jobs and hiring people in September? And that obviously goosed the overall numbers. And what are your thoughts about that?
Well, part of it could be in preparation for the presidential election, right? And part of it could be to absorb, to provide work for the new immigrants that came in, right? And it's important that it used to be that when government had workers, the pay was considered low. But nowadays, we cannot say that because the pays are quite high. And so the question then is, will this number be reversed right? Especially the election
Yeah.
related workers after the election, right?
Mm.
Yeah.
Okay.
Mm. And so looking forward in the near 1-2 month, we could expect some additional consumer spending because the mortgage refinancing has climbed up, and this usually translates into this windfall being spent at the shopping mall, right? And one of the major banks, right, has revised their forecast for Q3 to 3.2%. That's very strong. That's a very strong growth, considering that the trend rate, the speed limit, potential GDP for the US is only 1.8%. Right? And a lot of focus on the dock workers strike, and this affect major ports around the country. And when we look at the details, like this involves 45,000 union workers, sorry, typo, and affected 36 East and Gulf Coast points. The strike is now suspended, right? And at the moment, they have agreed on a 62% pay rise over 6 years. And negotiation will continue until January 15. Again, sorry, typo. I might be doing this too early in the morning. And the key here is that the 62% pay rise over 6 years, right, is equal to a compounded annual rate of 8.29% per year. So, would other workers want to have an 8.3% pay rise? I think so. I think so, right? So, at the minimum, workers will start asking their union bosses, say, hey, what's going on? Are you do anything, right? Those guys are getting money and we are not, right? So I think given how we are in a tight labor market, right, and companies seem to want to retain workers, this may open up a lot more demand for wage increase, and that's not good for the Fed, who is expecting inflation to decline further. And when we look at the early estimate on the on what could happen to the economy and inflation, it looks like the Trump administration would create a strong economy and more inflation, right? However, having said this, watching all the past presidential election, sometimes what was said in the campaign may not turn out to be implemented, because the president would have to deal with a lot more push and pull before deciding on what actually will be implemented. Monetary policy, this is an old slide, sorry. Sorry for this. Okay, yes, sorry. So Powell, right, is now trying to tone down the market expectation and says that rate cut can sustain soft landing, but sees no need to rush, right? And because of that, the 2-year Treasury note sold off sharply and interest rate back up quite a lot, right? And as Dan was saying just now, it'd be nice to see the curve steepening so that the banks can borrow low and lend high, right? The bond markets, well, whoever wins the election is going to increase the national debt, right? And this is going to be problematic if and when the market feel that there's nobody is going to try to reduce the deficit, and the momentum is going to push this deficit higher and higher over time. And here is our TLT. I'm not an expert on technical analysis like our friend Jim, but if you can look at this line here, and we see the gap down, right? So my guess is that we are going to try to shoot toward the 94 level, right? So there will be a drop of about 8 points over the last couple of weeks. That's a lot of money for investors to lose 8 points over a couple of weeks, right? So therefore, I always watch the TLT, and I'm surprised that some people do not realize how volatile this TLT can be. Dollar is now um, expensive when we look at the CPI based real effective exchange rate. This is the trade weighted dollar. And you see the dollar is expensive, right? Compared to the yen and the renminbi, right? So this may suggest that over time, the dollar could weaken. Energy, kind of interesting because there was a lot of concern that speculation that oil price can go lower because the Saudi had enough of the other members cheating, and they warned of $50 oil, right? If the OPEC members continue to not follow the agreement to maintain production cut. And this happened at a time when the inventory for crude oil is extremely low. And when you're low inventory, obviously the question is how far can oil price go down, right? And the surprise is that we had the escalation of the war in the Middle East, and the people who have shorted oil would had to force to cover, and we broke above the downtrend line. So then, back to you.
Okay, so turning to the Magnificent Seven, again, another choppy week. The prior week was kind of mixed, and this week was also mixed in terms of the Magnificent Seven. And I thought I'd take the liberty of showing everyone what I meant by the Magnificent Seven name seems to be losing its upward momentum. So let's just flip through these in market cap order. Next slide, Mike. Have Apple. You can see that it's leveling off here. The upward momentum is no longer there. Next slide. This is Microsoft, also going sideways to down recently. Next slide. NVIDIA, sideways to up, probably going to be bumping up against resistance here. Next slide. This is Alphabet, which had dropped a bit, came back a little bit, but I think it's going to be hitting some near-term resistance as well. Next slide. Amazon, also going sideways. Next slide. Meta is one of the two that's actually still showing upwards momentum. Next slide. And lastly is Tesla, which also is showing upward momentum. So you have 2 out of the 7 Magnificent Seven names showing upward momentum here. And I think investors are beginning to look elsewhere and diversifying. And we clearly are seeing that with other sector performance taking leadership. Next slide, Mike. Turning to the sector performance, as I mentioned, energy came back with a vengeance for the week. Energy select Spider ETF up 6.9%. And then pretty much everything tailed down. Financials were up a little bit. Utilities were up. Communications, and that kind of trails off. It was generally a choppy week. A lot of the names that had led in previous weeks kind of reversed Tech is kind of in the middle here, not showing any leadership anymore. So it looks like the market's searching for new leadership, and I think as we get through earnings reports this month, we'll have a clearer picture as corporate CEOs and CFOs give us a better give us a report card and forecast for what they're looking for, looking to happen in the near future. Next slide, Mike. Turning to factor performance, buybacks and the hedge fund guru index were the leaders. Spinoffs were also up there among the qualitative factors. IPOs were among the worst for the week. Turning down to style, some of the momentum names were still adding value. High dividend yielding stocks, which we saw in our income fund, were also up strong on the week. And then we talked about the Russell Growth Value ETFs. Small caps were lagging during the week, and small caps do tend to lag when interest rates are backing up. So that is no surprise there. Next slide, Mike. Turning to commodity action, the big spike in West Texas Intermediate crude oil, up 10% on the week. Brent also up 9% plus. Pretty much all the energy commodities, with the exception of ethanol, were down. So the impact of the Middle East war expanding is having an impact there. Turning over to the metals on the bottom, the industrial metals still continue to show strength, led by steel. Silver is kind of a industrial and precious metal that was up second, and then aluminum continued to be up. Copper pulled back a bit, which we have to watch. We usually like to see all the industrial metals going up in unison. Copper pulling back is something to be concerned about. Many market pundits call copper Dr. Copper because it tends to be the best predictor of the economic outlook. So copper is one of those commodities everyone watches for indication on what's happening in the economy. Next slide, Mike. Turning to the agricultural commodities, you see most of the food commodities were up: corn, cattle, wheat, feeder cattle. So that's something to watch, because obviously if food prices go up, that's going to be a big problem, as that's going to register in the minds of consumers with continued increase in food inflation, which would be a big problem. Next slide, Mike. Turning to the economic calendar, I got a lot of Fed speeches on Monday, and got some used car prices Tuesday, additional speeches, some trade data. Not a very interesting day on Tuesday, a little crude oil stock change. Wednesday, next slide, Mike. Wednesday is the typical mortgage data we have, some energy inventory data. The FOMC minutes on Wednesday, 2 o'clock, will be a very interesting read. It'll give us some insights as to what the Fed discussed at their meetings and what they're concerned about. Next slide. And Thursday, we get the real heart of the macro data that moves the markets, the inflation numbers, 8:30 a.m., and that's going to be very important. There are also some mortgage rate numbers and a couple of auctions we need to watch. And initial jobless claims will also be something we're going to be following closely. Next slide, Mike. On Friday, PPI will be important, and a Michigan consumer sentiment. Next slide, Mike. Turning to S&P 500 corporate earnings, this really begins to kick off the financial sector, especially on Friday. I'm going to point you over to the rightmost column. Most of the numbers we're seeing now from this group are showing down earnings versus a year ago. So these companies are basically showing fundamentally weaker earnings. And if that trend continues and the outlook is negative, these stocks will probably continue to face some pressure. But versus a year ago, names like Delta, Domino's, BlackRock, JP Morgan Chase, Wells Fargo, they need to talk about earnings growth moderating or turning around, or these stocks will probably continue to face some pressure here. So we got some food stocks, PepsiCo and Domino's. As I mentioned in the past, we like to see what's happening among the food stocks to see what the impact of the Ozempic and GLP-1 drugs have been on their businesses. My guess is that it's going to be negative because people who are on these medications tend to be eating less, especially the certainly soda and pizza. So I don't see positive outlooks or changes in their businesses. Overall, I think it'll be an interesting week in earnings, especially on Friday, and hopefully the financials will have some better news for us. But I personally think it's going to set the stage for some increased volatility, especially on Friday and into next week. And with that, Mike, next slide. Closing it out. As always, we are available to speak with our investors and interested investors to contact us and schedule one-on-one calls with us or answer any questions you might have. And to do so, contact Cleveland Ashley, our regional director. His number and email is listed here. And with that, look forward to talking to you soon. And Mike, if you have anything to add before we close, please do so. You're muted, Mike.
Yes, we are happy to help, and let's not wait until the next podcast. Something happened on Tuesday, Wednesday, Thursday. Let us know if you want to chat, and we get on the phone.
Okay. Thank you, everyone, for tuning in. Have a great week, and we'll see you next week.
Bye bye.